Good evening, folks. Lipalai Baka Juju Yam Kela Faku. Good evening, and welcome to Thursday night TikTok live Q&A evening. Be aware, Leonora. Good evening, everybody. Please, if you have any questions with regards to financial advice, investments, whatsoever, please put it in the chat, and as per usual, I will try and answer your questions on financial advice, investments, pre-retirement planning, etc. Good evening. Welcome, good evening. Dreams Designer Beds. I wonder if that's your company's name. I suppose it must be. Wuzmuzi and Plumber. Plumber, you must get the name for your company. Avo 6020 is AV 060287. Okay. Good evening to you folks, and welcome to Thursday night Q&A. Please do put in your questions. Hi Kit, good evening to you. Please go ahead and let me have any questions that you have with regards to financial planning, and then we will take it from there. I see I have been getting a lot of questions again on tax-free investments. A lot of questions on tax-free investments. And people wanting to know whether they can have more than one tax-free investment, whether they should only have one tax-free investment, etc. So, tax-free investments are great. It is really a very, very good investment. And the thing is, it is a very good investment if it is an investment that you're going to do for a very long period of time. So I would say anybody that's going to keep a tax-free investment for 15, 20 years or longer, they're really going to score in terms of the fact that they've got a tax-free investment. But having 3 or 4 or 2 even tax-free investments just doesn't make sense to me. Because you as a client, you need to basically remember how much you're putting into each of your investments. And very often with investments, you get the opportunity to do a premium increase on those investments. So if you have 2 investments and you started them at, let's say, 2,000 Rand a month or 1,000 Rand a month, it's not going to be a problem when it starts off. But as time goes on and your premiums increase, at some point, you're going to exceed what you can put into your tax-free investment on a yearly basis, and then you're going to be taxed on it. So I believe from an administrational point of view, and also the fact that the tax-free investments that we can do through good investment insurance companies, one tax-free investment is the best to have. Do one, then you don't have to administrate various tax-free investments, and you also know that SARS is going to keep you updated or keep you honest much easier than when you have multiple tax-free investments. So that's just a little something with regards to tax-free investments. Can I retire and live off interest of an income fund yielding 0.8% interest per month? So let's see. Let me just do a quick calculation here because it's late in the afternoon. I don't think my brain is willing to do these types of calculations. So your question is, can I retire and live off interest of an income yielding 0.8 interest per month? So 0.8 interest per month is 9.6% per year. So this is basically the long and the short of it. If your income that you are going to take is going to be less than 9.6% or equal to 9.6%, then your capital will remain as is and you won't have a problem. So what you need to then check with regards to something like that is, what is the income that I am taking? Let's say that the income that you are taking is on the dot 9.6% interest, similar to what your yield is for the year, and then you you still have a fee on that. The investment company is obviously going to charge you because they have to manage your funds for you. Let's say there is an additional fee on top of that of 1.4%. That means that you are actually going to see a depletion in your capital, because you're taking the full 9.6% that you're getting, but you have not accommodated for the 1.4% of fees. So the capital is going to reduce by 1.4%, which then means that in the following year you don't take 9.4% anymore. Now you must take 10% to accommodate for that fees that you did not accommodate for. If you are ever going to take an income of, let's say, 5% and you're getting the 9.6%, then there should not be any problem whatsoever, because your capital is going to keep on increasing. So I'm trying to explain to you the pros and the cons with regards to something like that. And in terms of the growth that you're going to get and what you take as an income, those two factors will be a determining factor on answering your question. Can I retire and live off the interest and income yielding 0.8% interest per month? You can, if the income is going to be sufficient, if you're not going to eat into your capital, if you can take less than the 9.6% per year so that you actually have an increase in your capital growth, if you don't need an income increase over the years. There's a number of factors that needs to be taken into consideration. Here's the other thing. Let's say that you get this income yield of 9.6%. Okay, let's say you get that. But the income that you're taking, or the income that you need, is going to be 10 or 12%. Then it's not going to be sustainable. So unless we know what the income is that you require, and we can go and measure that against the yield that you're going to get, we cannot say for certain if it's going to be enough. You could retire with a capital amount that is so large that even if you just take 5% as an income or 4% as an income, you're already going to have more income than what you need. Then the 9.6% is a no-brainer. It's going to work 100% for you. But I hope you see what I'm trying to say to you. It's impossible for me to say, based on a question like this, if you can live off that interest. Because if you can live off the interest depends on what the actual income is that you need, and a number of other factors. So I've tried to explain it to you and answer it the best I can, but if I haven't hit the nail on the head, well, maybe you should just put a second question in to see if we can get more clarity on what you want to know. AV, what is your advice with drawdown percentage on capital with growth? AV, funny enough, your question now very nicely fits in with the previous question. So my personal opinion is, I know that the majority of the financial world says 4% is a safe drawdown, meaning that if you take 4%, then it basically doesn't matter what the growth is that you get. As long as you get a growth that is basically equal to money market or better, your capital will always be sustainable for the rest of your life. Now, I feel that 4% is very, very conservative. I feel that 5% is already a sustainable income. But I do have clients that is taking 6, 7, as much as 8% income, and still it is sustainable. What makes it sustainable at the end of the day is the portfolios that you invested in. So if you are invested in any portfolio whatsoever, whatever income you take, if the portfolio growth is anything from 4 to 5% higher than what your income is, then I believe it will be sustainable. So if you are going to take an income of, say, 8%, and you can get a 12 to 13% return on your investment, 4 to 5% above the 8%, then I believe it's going to be sustainable. If you're going to take 10% as an income, and you can get 14 to 15%, I believe it's sustainable. So my advice with regards to the drawdown percentage is going to be directly related to the amount of capital you have, the amount of income you need, and then the amount of risk that you can take. For example, most people don't want to take risk when they go into retirement. They want to have a reasonable, secure investment so that they are not too badly affected by markets going up and down. So then a 4% income is actually a good income, because now you can go with a very conservative Now you can go with a very conservative, very safe, income option, if I can put it that way. So you can choose a money market fund, you can choose bond funds, those things that I don't really like. You can choose stable funds, very conservative funds. If you are taking a 4% income, you can use any of those very safe funds, and your capital is going to be sustainable for the rest of your life because you're taking such a low income. But the moment that you start taking an income that's going 6, 7, 8, 9%, then you have to take a bit more risk. You have to go and get more aggressive with your investments. And my personal opinion is people that go into retirement that has to take an income, they can be more aggressive with their investments because you normally go into retirement from the age of 55 to 65. And with life expectancy being around the 80s, it means that you've got anything between 15 to 25 years of investment time. That's a long investment period that you've got. So you can be a bit more aggressive. So the percentage drawdown is really going to be determined by your needs on the one hand, your risk, how much risk you're willing to take, how aggressive you're willing to go, and then if the portfolios that you invested in can accommodate for the growth. If that works, then it's perfect. I've got a few clients that is actually taking very high incomes purely because that's their financial situation, and they've taken very high risk portfolios. And for the last 2-3 years, it's been sustainable. Yes, investment growth has been great over the last 2-3 years, but it's been sustainable for them, and their capital hasn't suffered much over the last 2-3 years. But it is a risky exercise that they're doing purely because they are in financial need. They are in dire straits. For you yourself, everything depends on how much capital you're going to have and how willing you will be to take some form of risk. Okay, AB, I hope that answers it for you. If it's you sending me all the hearts, then I suppose it is answering it for you, so I hope so. Let's see who's next. Hi, good evening, Rowan. How are you, sir? Rowan's one of my advisors, and he's very good when it comes to GPF funds. And I see he's joined us tonight. And there's Mr. Antsman. Good evening, Mr. Antsman. Two of you sitting in the Cape Province. I believe that the weather is pretty nice, although you haven't had rain yet, which is a bit of a problem. Let's see who's next here. Let's see who's next. I've got a lot of people, but I'm not seeing. Here we go. No, thought I saw a question. It wasn't the question. Here's one. Number 2 says, you've hit the nail on the head. Key is to keep monthly expenses lower than the yield for capital growth. Absolutely. At the end of the day, that is as easy as investments is that you want to keep the income that you get from any investment lower than the actual capital growth that you earn. As long as you can do that, you're well away. There's no problem. It is also, however, a situation, like I said, with the clients that I've got that needs to take a substantially higher income, that some people are in dire straits, and then you have to take a bit of risk and you have to take a bit of chances. And then sometimes you almost have to gamble to the effect that you start digging into your capital, knowing that you're going to exhaust it somewhere into the future just to make sure that you make ends meet. It's not a happy situation to be in, but at least if you are in such a situation, you make sure that you regularly check your investments, regularly review it with your financial advisor, make adjustments if needed on a regular basis, then you should be okay. Obviously, you need to have a financial advisor that actually understands a little bit on investments so that they can guide you with regards to what is happening in the market, what's happening with the portfolios, etc. But yeah, regular checkups, and when I say regular checkups, once a year at least. Charlene says, how do you protect yourself in a market downturn? So Charlene, the easy answer is by spending time in the market. That's how you protect yourself. I think that most people want to try and time the market. People say, no, I want to invest for the next 20, 30, 40 years until I retire. This money is for then, or it is for 10 years, 15 years, 20 years down the line for my child to go and study, or. Now, if you're going to be invested for such a long period of time, okay, then the best way to protect yourself is to choose an investment strategy. That means you decide how much risk you're willing to take upfront, get into the market, so get into your investment and into the portfolios that you, your financial advisor, has decided is the best for you, and then to stick it out. Because now it doesn't matter what happened in terms of market up and downs, up and downs, up and downs. As long as you have said, listen here, let's take 20 years as an example. As if you've committed yourself to a 20-year investment and you've committed yourself to being in a very aggressive fund, for argument's sake. If you've invested, okay, and you leave your money there for the longest period of time, it doesn't matter what the market does in between. All you have to be concerned about is, I bought in here at this very low point and I want to get out here at this very high point. When I'm at this high point, that's when I want to convert from very aggressive to maybe a bit more conservative, a bit more guaranteed or safe or something to that effect. So the best way to protect yourself is to stay in the market. Get in, stay in for the longest period of time. So let's use this example of 20 years. Market downturns over the years, the longest recovery that there's ever been has been something like 38 months, 3 years and 2 months, and that was after World War II. All other market recoveries has been in a substantially shorter period of time. If we think back on COVID, the COVID recovery was 6 months. Boom. Within 6 months, everything was recovered and better. So for somebody that's willing to stick it out for 20 years in investment, I would say in those last 2 to 3 years, that is when you start looking at your investment on a more regular basis, and where you almost have to go and pick a point and say, listen here, once I get to this point, that's when I'm going to climb into the market. I'm going to accept the growth that I've got. I'm going to lock it in. I'm going to stay into a more conservative fund. I'm going to be happy with everything that I got from this point to that point. So I'm going to lock it in. And you have to put a stake in the ground and say, when it hits that figure, once my investment hits that figure, that's when I'm going to do it. The problem is that people want to try and time the market. They want to get in here at the bottom, but then if the market goes up, they want to say, okay, when it's going to turn around and go down, I want to get out here and wait until it's down here, and then when the market goes back up, I want to buy in again. And they want to try and time the market, and it's been proven over and over and over and over again. Nobody has ever gotten that science right. The stay in the market from this point to this point, instead of buying and selling, buying and selling, buying and selling, outperforms 99.9% of the time. So in a market downturn, if you've picked your strategy and you're willing to stay, then you are going to be protected. Now the thing is, people that goes in for things like 20 years, they've gotten good growth from year to year. Now we sit and we talk about that stake in the ground, that amount. Once I hit this amount, that's when I will get out of the aggressive fund and go to something conservative. I will consolidate my growth that I've gotten over the years. But then what happens is, because I'm here now it's like, okay, let's just hang on a little bit, because the market is doing well. Let's see if we can just go a bit higher, bit higher, bit higher, bit higher. And then eventually market does do a bit of a downturn. And now they hang on, because now they were on 1 million rand in the investment, and now the investment is down to 980,000 rand because there's been a bit of a market downturn. Now they want to hang on. They don't want to get out because they feel they've been done in by having 1 million. Now they're down to 980. And suddenly they start trying to time the market again. And that is when people lose. That is when people battle in market downturns. Is I'm happy to buy in, I'm happy to stick it out, and then when I get to this point here at the top, where I have to put that stake in the ground, if the markets are doing a little bit on the good side, then I just want to hang on for a little bit more, a little bit lower, and then they start timing the market again. So it's a very difficult psychological thing to help clients to come to terms with. Make peace. Take your winnings at this point and go. So you can't protect yourself in a market downturn, especially if you're going to be buying and selling, if you're going to try and time the market. You can only do it, according to me, if you stick in the market and you spend time in the market. And then as well, by choosing good portfolios. I mean, that is what we do as financial advisors. I advise clients as to what is the best products and then what's the best portfolios for them to be invested in based on the risk that they can take. And then I make use of portfolios from portfolio managers that I trust, that actually has a proven track record, that they actually foresee when the market is going up, and they're making sure that they are in the market to get the gains, and when the markets are going to go into downturn, they go out of the market and they protect themselves more. Good portfolios, that is the only other thing that can help you to a certain extent to protect yourself against market downturn. Okay, Charlene, I hope that answered it for you. It's a bit of a long answer I've given you, but it is one of those things that are definitely not easy and cannot be answered in one or two sentences unless you want to, I almost want to say, confuse people more than assist them. Buntu says, lots of hype around property investment. What's your opinion? Buntu, I'm not a big fan of property investment. I've said it many a times. I am not a big fan of property investment. But I think let's clarify that. What I mean with I'm not a big fan about property investment is people, individuals, us as individuals, want to go and buy a second house, a third house, a townhouse, a flat, and we want to rent it out, and we want to build a property portfolio. Building a property portfolio is like starting your own business. And starting your own business is one of the most difficult things in life. I mean, statistics already tells us that 2 out of every 10 companies that starts actually survives. And only 1 out of those 2 that survives actually makes it good one day, makes it big one day. So when people talk about property investments, they're normally talking about, I want to build it, buy a townhouse, I want to rent it out, and that's going to be my pension. One property, according to me, is more risky than being invested in a high risk portfolio. With if you do not understand property and know how to act in the property market, it's very risky. What I do think, however, is that there are so that's individuals. Individuals wants to buy a house, townhouse, a flat, and rent it out. What does investment houses do when they talk about property investment? They don't go and buy 5 houses and rent them out. They go and buy into a commercial property. So they go and buy into a very big shopping center where they've got anchor tenants, they've got guaranteed income with regards to rental income, etc., etc. They know that if they buy into this property, because of the rental contracts that's already in place, the anchor tenants, the expenses, they know already that property, that commercial property, is going to give them a guaranteed return, let's call it of 10%. That is what investment houses do. They buy into property, commercial property. So I'm saying that if you want to be invested in property, then that's the route to go. Go and buy into a property portfolio with a good investment house, and let them, the portfolio managers and the people running it, let them worry about everything, the rent, the maintenance, the whole tutti. And when it comes to that as well, I'm definitely not in favor of putting all your money into a property investment. A portion, yes, maybe. I've got, in all of my portfolios that I've got, I don't have one property portfolio in my own investment portfolio that I have. Yes, there's some of the funds that I'm invested in that has certain percentages where the portfolio manager has bought into property. But personally, I don't have one property portfolio in my investment portfolio. So that's my opinion. I think that if you want to go and buy into property and you make the mistake that most people make by buying 1 or 2 townhouses or houses and renting it out and thinking they've got this brilliant property portfolio, then it is most probably one of the worst things that there is. Buying property and renting it out is running a business. So if you, and this is what I always say, if you are a mechanic and you don't know how to run property, then don't get involved in it. Do something that you know and understand. So if you're a mechanic, rather buy second-hand cars, fix them up and sell them, because you know cars, you understand how much it's going to cost to fix up that car, and you know that you're buying a bargain, because you're buying this car for 10 Rand, you're going to spend 2 Rand to fix it, and then you'll be able to sell it for 18 Rand. So if whatever you're into, go and look at possibilities in what you know and understand if you want to do something like this. Property, to me, it's always been a risky business. There's people that does brilliantly with property, but they're doing it as a full-time job, basically. They're not playing around with it in the hopes of making it good. Okay, that was that. Shamiz, how much money does one need to start an investment? Shamiz, you know what, very little. Some of the investments that we can give people starts from as little as 400 Rand a month. So you really don't need much. And as a matter of fact, I did a video the other day where somebody says, well, if I'm earning only 10,000 Rand per month, and I don't have 10% to invest, where do I start? And I said, well, then start with 100 Rand. If you're earning 10,000 Rand, start with 1%. Take 100 Rand and put that 100 Rand into a bank savings account every month. Do that for 3, 4, 5, 6 months until you see, but listen, yeah, I'm getting along without this 100 Rand. I've disciplined myself to put 100 Rand away every month, and I can get along without it. Then put in 200 Rand. And build yourself out. It's like training. You have to build yourself up financially disciplined to get to that point. And it's a bank savings account, so it's not a fantastic investment, but it is something until you can do the step up to the next type of investment. Retirement annuity, unit trust, endowment, whatever the case might be. So you really don't need a lot, and you must just do it with discipline. That's the most important thing. And start small, and then just build it up. Okay. Avi says, having an additional retirement fund for rebate to put in tax-free investment, yes or no? Having an additional retirement fund for rebate to put in tax-free investment, yes or no? So retirement annuity, remember one thing, your retirement annuity contributions, the premiums that you pay on a monthly basis on the retirement annuity, you can deduct that at the end of every tax year from tax. Okay? So you get that tax rebate on those premiums. And all the growth inside of that retirement annuity is tax-free. Okay? So those are the tax benefits on a retirement annuity. Then at retirement one day, the income that you're going to generate will be taxable again. So that's how the taxes work there. On a tax-free investment, it says any money that you put into this tax-free investment, all the growth that you're going to get on that is going to be tax-free, and whenever you take it, it's going to be tax-free. So there's two slight differences with regards to it, and you need to decide what you want. If you want the rebate in terms of your contributions because you want to pay lower tax now, and you accept that somewhere in the future when you get an income it's going to be taxed, then the retirement annuity is the best option to go, because both of them, tax-free and retirement annuity, the growth inside is tax-free. It's just the premiums. On a retirement annuity you get a further tax benefit now with the premiums that can be deducted from tax, and then somewhere in the future you will pay tax on the income. Where on a tax-free investments, you don't have the tax deduction of the premiums now, but one day in the future when you start taking income, it's also tax-free. So there's not really this one or that one scenario where the one is better than the other. There's definitely not something like that. Each of them has its place in the market. Each of them has its place in a client's portfolio. And it's going to depend once again on your personal circumstances and what you want from your portfolio, which one is going to be best. And most people that has the ability to invest, they do both. You go and speak to any person that is a good saver, a good investor, and they will have a retirement annuity and tax-free investment. They will get the benefit on both sides of those tax-friendly investments. Kuketsi, time in the market beats time in the market. Absolutely. Time in the market always beats time in the market. Time in the market is like time in the market is putting your money away, forgetting about it, and let time do its thing. One day you will be surprised. Timing the market is basically like going to the casino and gambling. Every now and again you're going to hit it big and you're going to have a nice big score. But more often than not, you're going to walk away most probably with more losses than wins. That's the way I see it. Paulina, what's your advice on gold funds? Paulina, I do not have any advice on gold funds. I'm not a big fan of gold funds. I know gold has had an incredible run. Just like Bitcoin has had an incredible run. Just like software companies. AI is having a fantastic run at the moment. The thing is that things such as gold funds, Bitcoin, AI, software, all of these things do at some point, a specific sector of the industry is going to have a good run. And it's normally once it's had a good run that people starts realizing it, and then everybody wants to go into it. I think that gold is a high risk investment because it is one commodity that you're buying into. I would rather invest my money into something like an equity fund or a balanced fund where there will be some gold shares in that fund, but there will also be other shares. There will be software, there will be AI, there will be commodities, silver, platinum, gold, there will be retail, everything. And I leave it up to the portfolio manager to move from the one sector to the other sector as they see the market moves. But personally, I don't like gold funds. I know it's had a fantastic run, and you know it's almost the same as backing one horse in a race. You've decided this is the horse you're going to put your money on, and that's it, and you go for it. And if it wins, it wins. If it doesn't, it doesn't. So that's my opinion about gold funds. I think it is something that if you are going into it, if you're going to invest in it, you're going to have to make sure that you are happy to stay invested for a long, long time. Because if the gold market, the gold price takes a dip, which it has done recently, and you climbed in at the top, you're most probably sitting at the negative at the moment, and now you have to wait until that market has eventually recovered. And trust me, things like commodities such as these, the recovery time is normally substantially longer than what the normal market recovery times are. So that's my opinion on that. Lali, what is your advice regarding buying into a retirement village, or is renting better? Lali, yes, I wish I could give you a straightforward answer with regards to this, but I'm going to tell you what I normally say to people. Every person's situation is different. Every person's situation is different. For some people, depending on their personal circumstances, it might be better to buy than renting. So, for example, a few years ago, I had clients that was going to retire, and they could buy into a retirement village from the age of 50. The retirement village allowed for that. So they went and they bought a house in the retirement village, and they moved in there at the age of 50 already. And that was a very good move for them, because their life expectancy is, like I say, around about 80. So they had 30 years that they are going to stay rent-free in this retirement village. Now I've got another lady that just the other day, her husband passed away, and she is 81. Now she has just sold a house, and she, let's face facts, we all have an expiry date. She knows she's in reasonably good health, but she's definitely not going to live for another 30, 40 years. So for her, it might be better to just go and rent a place, because if she manages to get to the age of 95, for argument's sake, it's 13 years of rent, and it's most probably going to be more cost effective, the rent that she's paying over 13 years than what it would have been if she put down a lump sum and bought a place. So it's really going to depend very much on your personal situation, your personal needs, your personal wants, your personal financial situation. It really depends from person to person, and therefore I never have a set hard and fast rule when it comes to buying or renting. It's going to depend from individual person to individual person what will be the best for them. I hope that answers it for you, Lali, or gives you a bit of a guidance. Insightful Accounting says, I have found my people, time in the market. Absolutely, absolutely. Charlene says, is growth funds or dividend paying stocks? Yes, it's Charlene. Charlene, it really depends on what you want. Okay, growth funds is normally for somebody that wants to invest money over a long period of time and wants to have good capital growth. Dividend paying stocks is normally better for somebody that wants to generate an income. So it's very much going to depend once again on what your need is. There is no right and wrong. It's like anything. When we walk into a shopping center or to Checkers to go and buy bread, you can't tell me that it's the best thing to buy is white bread or brown bread or coney buns or hot dog rolls. It's really going to depend on the person that's buying it, what they like, what they believe is the best for them, what they want to use it for. It doesn't help for you to tell me, listen here, when you're going to buy your bread, you must buy brown bread. When I say, but I want to make hot dogs for lunch. Because if I want to make hot dogs for lunch, it makes sense to buy hot dog rolls. So it's exactly the same with investments. It really depends on what you want your investment to do. So growth funds, long-term growth, fantastic. Dividend paying stocks and funds like that, income. You want income? That's the one that's preferable to go to. I hope that answers it for you to a certain extent, Charlene. Hello, says, good evening, Corneille. Last year I had to pay SARS because I exceeded the threshold. Oh, ouch, that's not nice. My wife had to pay the same. Why? I am married COP. Should the tax payment be divided 50-50? I cannot give you a straightforward answer with regards to that. Hello. What I can tell you is that basically when we are married 50-50, it says that all our assets and our liabilities is shared 50-50. So if we are married, me and my wife, and I go and buy a house, I bought the house, so I want it to be just my house, but because we married community of property, she is half owner of it. I can't do anything about it. But at the same time, I now owe R1 million on this bond. So it's not only my R1 million, it's half of it is hers. She owes 500,000. So we are in it 50-50 no matter what. But when it comes to taxes, it's a different situation. Because you pay taxes on your personal income. So you get tax rebates on your personal contributions. So you and your wife, you might be earning 50,000 Rand a month and your wife will be earning 10,000 Rand a month. So you will be in different tax brackets. They're not going to say we're putting these incomes together and we're going to give you one tax bracket. You pay tax on your 50,000 Rand per month income. So on your 600,000 per year, you will be in this tax bracket. Your wife on 120,000 Rand will be on this tax bracket. And the same goes with regards to the tax rebates. If you are contributing towards a retirement annuity, you get the tax rebate on your retirement annuity. You can't say, listen, I'm going to give it to my wife. You must actually take out a retirement annuity in your wife's name for her to get a tax rebate. So, unfortunately, when it comes to the paying of taxes and what happened to you, you can't go back to the receiver and say, hey, we married community of property, you have to split it. Not going to happen. That is an individual situation. Okay. Let's see here what Fura says. Fura says, I only have ETFs. Fura, if you only have ETFs and you're happy with that, by all means, go for it. ETFs, there are some very, very good ETF funds. I'm not the biggest fan of it. I like actively managed funds more, but everybody to their own. And like I said, there are very good ETFs out there, and they've got a place. Very often when it comes to things like living annuities, there's specific ETFs that's very good to build into a living annuity. So number 2 says, are balanced funds low, medium or high risk versus income funds? So a balanced fund is a medium risk fund. Okay, that's as easy as that. An income fund is normally a low risk fund. So a balanced fund is normally something that has approximately 65% shares in it. And then the rest, the other 35% is made up of cash, bonds and property. And that's why it's medium risk. In times when it's growing nice. But in times when the market has a downturn, the portfolio manager puts more in cash, bonds and property, and that stabilizes it. And therefore you see a more steady growth. You don't see anything shooting out the stars, but you also don't see substantial downfalls, and you have a steady growth. Income funds are more invested in things like cash and yields and stuff like that, where we know we invested in a good company that every year has consistently produced good profits, like Coca-Cola, for example. We know that Coca-Cola is going to be there forever and a day, so anybody that invests in Coca-Cola are just about 100% sure that they're going to see a profit every year. And that's what income funds does. They invest in something that is much lower risk. It's not going to shoot the stars out, but you know that you should get a relatively good return on your investment on a year-by-year basis. So income funds low, balanced funds medium. Bob Spanner, good morning, Konay. What is your view or thinking on that retirement money should not be taxed? Bob, no. You see, the thing is, retirement money, the retirement annuity, pension fund and provident fund that you contribute to, you're getting the tax benefits now. You can deduct the premiums from tax, so that's number one. And then all the growth in the fund is also tax-free. So you're getting, you're scoring tax on two sides. You're scoring tax in terms of less tax that you pay because of the contributions that you can deduct, and then you're scoring tax because the growth is tax-free. They're not taking that off. So at some point, you have to pay something. You're going to have to hoe sê hulle? Jy gaan die keiser moet betaal op 'n stadium. So it makes sense to me that when you go into retirement, then you're going to pay tax on the income. You know that even in America with their retirement funds that they've got there, you've got funds where you can choose, a retirement fund that you can choose that works the same as ours in South Africa, and then you've got a different retirement fund where you can choose to invest your money, be taxed on it now, and then get a tax-free income into the future. So it's just turned around. So yes, unfortunately there is no ways that you ever going to be able to get away from tax completely. So my view is the way it's working at the moment is acceptable and it is fair. Rikash, what's the best investment for a 70-year-old pensioner with 1 million requiring a monthly income? Rikash, my mate, very difficult to say because I do not know what all your circumstances is like. I don't know how much this income is that you need. I don't know how good your health is. I don't know if you've got another income. I don't know if you need to make provision for other financial dependents. So there's a multitude of questions that I need to ask you before I can even dare to make a recommendation. Some 70-year-olds that does something like this is going to need a guaranteed income for the rest of their lives. Some are going to need a guaranteed income for only 5 years. Others are going to need a specific income, and they can therefore work on a percentage drawdown. So Rikash, like with everything else that I've said tonight, is there's no specific, there's no one size fits all. It always, with all advice, depends from person to person and what their needs are. Abel says, hi. Graham, how's the boat? Graham says, hello, remember, shared income both due to community property allows for interest rebate for each plus. Okay, so Graham is an accountant, folks, and me and Graham actually have a client that we been working with for many years, And so what Graham is quickly saying here is shared income due to community of property allows for interest rebate for both, which is a plus. So he's not contradicting what I said with regards to the income and that you're falling into your own tax brackets, but what he is saying is that you both can enjoy the interest rebate that SARS gives. So remember, when you earn interest on an investment, let's say you've got money in the bank and you earn 100,000 rand interest for the year, SARS says the first 23,800 rand of that interest I'm not going to tax you on, I'll just tax you on the difference. And what he's basically saying is that interest can be shared between husband and wife when they are, or that rebate can be shared between husband and wife if they are married in community of property. So thank you for that, Graham. I still think you must be on one night and we must talk together. You see, Graham, here's another tax question. I try and answer tax question when it comes to investments because that's the part that I understand. And then people start asking me income tax questions where I have to be very careful because I'm not a tax specialist. Need somebody like Graham to come and answer your tax questions one night. Abel says, Correa, I was auto-assessed, but do I still need to submit my RP5, medical certificate, retirement annuity, etc., etc.? Yes, Abel, I would say you should. And I think Graham could maybe pop in here in the chat again. But yes, I would say you should, because if you auto-assessed and SARS did not take into consideration some of those contributions, it might be that you could have gotten something back, but now you're not getting anything back because SARS is not aware of those contributions. So yes, I would say you still need to submit your IRP5, medical certificates, retirement annuities, etc. to SARS, even though you auto-assessed. That's my honest opinion. Who's next here? Tic-tac-toe. Good evening, Tic-tac-toe. Well, welcome. Nice to see you again. What? Have I gone through every? Cannot be. I've got such a blocked nose tonight. I'm sorry, folks. But it seems like I've answered all the questions, which is... a while ago I thought I was way behind. Now it seems like I've answered everything, okay? Insightful Accounting says, you only submit if you edit your auto-assessment and include additional info and SARS audits you. Okay. Let's just read that again. You only submit, and this is now the IRP5 and the medical certificate and the retirement annuity stuff. Insightful Accountant says you only submit that stuff if you edit your auto assessment and include additional information, and if SARS audits you. Okay, so there you go. Not sure it makes sense to me, but to all accountants and tax practitioners, that will make 100% sense. Tic-tac-toe. Where do you save for 30 months as often as you like, different amounts? Where do you save for 30 months? As often as you like, different amounts per month. Tic-tac-toe. I would say if it's 30 months, you do it in a bank savings account. That's my opinion. And the reason I say that, folks, if you're doing an investment for 30 months, okay, when you put money into a bank savings account, the amount of money that you put in, if you put in 100 Rand today, tomorrow you will see there's 100 Rand. There might be a little bit of bank cost, but tomorrow there will be 100 Rand, and at the end of the month, it will be, let's call it 100 Rand and 50 cents because the interest gets added. When you do an investment through the investments that we do, the difference is on the bank savings account, they give you a fixed interest rate and they tell you this is the interest we're going to give you. But the investments that we do, they tell you this, I'm going to charge you this cost, but I'm going to try and get you the best possible return. So on the bank savings account, if the bank says I give you 7% interest, that's what you get. The investments you do with me, if we go and we try and get 12% return on investment, and we manage to get it, you get the full 12%. Okay, now, but because it works like that, the cost gets taken up front. And when you now go and you look at your two investments that you've done, your 100 Rand that you put in the bank and your 100 Rand that you put in investment with me, your bank investment is going to be 100 Rand at the end of the month. My investment is going to be 96 Rand 50 because they've taken off the cost. So in the first year, 2 years, your cost must be grown back, if I can put it that way. And if you do not get that shoot the lights out 14, 15, 16% in terms of growth, then you are going to have less than what you had in the bank. So I would say, first of all, you put the money in a savings account over a 30-month period. If you really are willing to take the risk of trying to get a higher return on investment, then you can make use of something like unit trust. But then you must be willing to take the risk that's associated with that if you do not get the growth that you wanted to get, you might have been better off in a bank savings account. What's your take on ETFs? Which ones are you holding? Fura, I don't hold ETFs. Like I said, I'm not majorly crazy about ETFs. There's some very good ETFs out there, but I like actively managed funds, so all my money is invested in actively managed funds. Koketso says, I was auto-assessed in the previous years and I paid SARS. Can I still resubmit my RP5 for previous years? Koketso, I'm not a tax specialist. I'm trying to answer a couple of tax questions very broadly here, because people are asking about it. But you have to speak to a tax practitioner or consultant, to a tax specialist. They'll be able to tell you, okay. Would you invest 1 million Rand in a balanced or income fund for long-term growth? I won't make use of either, to be honest. If it's long-term growth, I'm going to be investing it in an equity fund. That's me. I like to be more aggressive with my investments, and I like to tell people to be more aggressive, especially if it's a long-term. So, if it's my money, my 1 million Rand, and I want long-term growth, I'm not going to make use of either the balance fund or just a second. I'm not going to make use of either the balance fund or the income fund. I'm going to go into an equity fund. Okay. Equities or ETFs? Equities every time for me, Neil. Zojo, please explain tax penalty on savings for people under and above 65. I don't know what tax penalty you're talking about here on savings. There is no tax penalty on savings. So this is the thing, people, folks, there is no tax penalty on savings. There's only tax benefits on savings. So I'm not 100% sure what you mean. There's different tax rebates, tax discounts, if I can call it that you get from SARS if you're under 65 and above 65. If you are under 65 and you've got interest, the first 23,000 Rand is tax-free. If you're above 65, then the amount is increased. I think then it's something like 25 or 28,000 Rand that's tax-free. But there's no penalties on savings, on investments. It's just tax benefits that you get on investments. Okay. Bank is bad news, Kunai. I'm talking about hundreds of thousands of rands. Tic-tac-toe, once again, even if it's hundreds of thousands of rands and it's a 30-month period, I'm going to have a very long discussion with you, a very, very long and intense discussion on fees and cost and understanding what the growth must be in order for it to be a positive return on investment versus a bank savings account. So the thing is, tic-tac-toe, is that on a 30-month investment period, there is a substantially higher return that I need to get for you, okay, on an investment to, after cost and everything has been taken into consideration, to still get the same as what I would have gotten on the bank interest rate, even when there's taxes involved. So even though it's hundreds of thousands of Rand, it's a serious calculation we have to go and do. You have to understand, first of all, how this costing can affect you. And then you have to understand what type of growth you need to get in order to match and then get more than what you would have gotten on the bank savings account. So it's whether it's 10,000 rand or 10 million rand, we're going to have a serious discussion for you and me to for before I will be comfortable that you understand how the cost implications could affect you and how the risk of the portfolio can affect you and how those two things together. If once you understand those two things together, then I can say, okay, maybe we can take a chance on the other investment. Finbond. What do you think of Finbond? To put my 1/3 there. France, I'm not the biggest fan of Finbond, to be honest with you. I know that Finbond has beautiful interest rates, but there's tax involved in it. I understand how the, how the guarantees work. Yeah, I'm not going to talk bad about Finbond. It's just not my type of investment, and I don't deal with those type of investments. And based on my knowledge that I have of companies like Finbond and others, I'd rather not invest my money or a client's money there. It's as easy as that. What about Old Mutual Global Equity Fund for 30 months? Too short? No, definitely not too short. But it is, once again, we cannot, as well as that portfolio has been doing over the last 26 years, I cannot give any guarantees it's going to keep on doing that for 30 months. If I had that crystal ball that said it's going to keep on doing it for 30 months, no problem. Double quick time, money will be invested there. But because I don't have it and I don't know what's going to happen, I cannot say that to somebody. So once again, my friend Tic Tac Toe, who does not want to contact me so that we can have a coffee or something, unless I have a proper sit-down discussion, we discuss all these costs and stuff, I'm not even going to chance my arm in making such a recommendation. My SARS app shows not calculated after filing Ray. Once again, I can't help, I don't know taxes. Tax penalty relates to exceeding, okay. Folks, we are at 6 o'clock. Ray says, okay, I've got two more that I'm going to answer. Equities, you pay CGT. No? Yes, you do pay CGT on equities. But it depends on what form you are going to have your equities, okay? You can have your equities in the form of direct equities where you've bought the shares yourself, and there's going to be a CGT implication which is going to be tied towards your personal tax rate. You can have it in a unit trust, same story. You can have it in endowment, but then it's CGT against company tax rate of 30%, not your own personal tax rate. So yes, there's always going to be taxes on investment, folks. It just depends on which investment you take, which is going to be most beneficial to you. Last but not least, OMJ, how good is unit trust and for how long to save or invest in it? Unit trust is one of those wonderful things that is completely liquid, meaning you can put your money in today, you can take it out tomorrow. The best is obviously, same as other investments, to do it for as long as possible. But how long? That depends on you. How long can you leave it? The longer, the better. If you resign at 64, a house tax, exactly the same as if you reside at 55, 60, 65, 70, same story. It's worked on a straightforward formula. It's not dependent on your income. Yes, it's 7 o'clock. You're right, tic-tac-toe. It's 7 o'clock, not 7. Okay, folks, that is me for the evening. I have had a long day. I want to go and grab something to eat, and then I'm going to sleep. Ray, last thing that you're saying here, active managed fund cost in fees than EFT. Mate, we can have a long discussion on fees. At the end of the day, I'm going to say what I always say. People are so concerned about fees when that is not the important thing when it comes to investing. Fees is important, I agree. But at the end of the day, the right investment choice is much more important. The right portfolio, much more important than the fees. Not saying that you should not pay attention to fees whatsoever, but there are other aspects that I believe is substantially more important when it comes to your investment portfolio. Okay, folks, it's been fun, but like I say, it's 7 o'clock, like Tic-Tac-Toe has just mentioned. I'm going to grab something to eat and then I'm going to sleep. Have a spectacular evening, wonderful rest of the week, and I'll see you guys again next week, Thursday, 6 o'clock. All the best. Keep well. Bye bye.